Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Sonal Bhutra. Well, it is the end of the week and there's definitely some amount of trepidation. We did have the FIIs which net sold after a couple of days of buying into the Indian market. But besides that, there is an overall trepidation probably ahead of that US jobs data, which will be out today in the US markets. We will be reacting to it on Monday. And remember, that's estimated to probably slow down to around 200,000 jobs in November as compared to around 261,000 jobs in the month of October. So if that comes through, that would definitely be a positive in terms of what the Fed would eventually do. Remember, this is the last employment data ahead of the Fed meeting on the 13th of December. That is probably one of the bigger cues that we're working with. JP Morgan said, yes, the pace has reduced. The Fed has taken note of that, but there is no pivot in the Fed at this point in time. That's something that Jahangir Aziz told us earlier in the morning. Couple of cues to keep in mind at this point in time. Hi, Sonal.
Hey, good afternoon, of course. So you spoke about a lot of global cues which will be tracked closely. There is some clarification which is needed in terms of China COVID policy as well, and that is the reason why Asian markets were on the back foot today. But apart from that, if we look at our own markets, we've seen continuous rally for the last couple of days, so there is some profit taking as well. And right now, as we speak, it is at the day's low. So let's see which way things go from here. For today, it's a big cut that we are seeing. But of course, the global cues, that is something we'll be watching out for.
Yes, absolutely. You know, not to mention that we have the RBI policy next week as well. So back home, let's not forget about that. The RBI will be meeting and we have the CPI data to reckon with in terms of, you know, the 7 or sub 7% figure. And separately, we do have the GDP data that they would take cognizance of, which was largely in line with estimates for Q2. But let's move on to some news then. In its latest revision, the government has halved the windfall tax on crude oil to 4,900 rupees per ton from 10,200 rupees earlier. Sonal, you've been tracking this story. Give us more.
Yes, it's very positive, the move that has come, and largely expected also because of the way crude prices have fallen in the last 15 days. To give you the numbers first, on crude oil production, the windfall tax has been cut to 4,900 rupees per ton, which is almost halved from the last number that we had, 10,200 rupees per ton. On diesel, it will reduce from 10.5 rupees per litre to 8 rupees per litre. On petrol, it's still nil, and on ATF, it continues to be at that 5 rupee per litre mark. It is a positive, as I said. Now, CLSA says that cut in windfall tax on domestic crude oil production is to the tune of $9 per barrel. This in comparison with the $10 per barrel fall that we've seen in crude oil prices. So it's $1 per barrel less, but still it is positive for the likes of ONGC and Oil India because it says that it is implying a post-tax realization of $78 per barrel. And right now these stocks are factoring in valuations of around $45 to $50 per barrel. So there is still scope for an upside. Just to give you some perspective as well, back in July when this duty was introduced, crude oil tax was 23,250 rupees per ton, diesel was 13 rupees per litre, ATF was 6 rupees per litre, and petrol was 6 rupees per litre as well. So there has been a massive cut from those levels as well. And yesterday itself, Jeffries had put out an interesting note where they said that they see the possibility of export duty on diesel ATF being withdrawn completely in the near future. And there will be a $2 per barrel impact in Reliance's earnings if this continues at these levels. But if it goes away completely, then in their FY24 EBITDA, there could be a gain of $1 billion. So that's around 5% of earnings and substantial as well. So these stocks will be in focus. We'll have to see, of course, how crude prices move from here on. They did surge overnight. But yes, for now, they are stabilizing at these levels.
Okay, all right. So that's on the windfall tax. But let's now focus on Paytm. Brokerages are in fact bullish on the stock. This is after the management, which held an analyst meet, says it expects to break even in terms of EBITDA by September next year. Surbi, who's been tracking this, joins in with the latest.
Hi, thanks for that. Paytm management hosted its first physical analyst meet here in Mumbai yesterday, wherein they have highlighted a large growth opportunity for the payments business in India. They have said that it has a potential of 100 million merchants and more than 500 million payment customers, and this opens an opportunity to cross-sell financial services and other business offerings. They also provided some granular details on their key revenue drivers across business segments and the breakup of key costs, which will help them to achieve their adjusted EBITDA break-even target by FY24. Additionally, they said they don't see any significant regulation risk to affect its payments margin. The net payment margin should largely remain steady even if there is a reduction in MDR, which is the merchant discount rate. They said on credit cards, they have seen significant pickup in the business momentum. On commerce business, management disclosed that the GMV was close to 2,000 crores and the revenue was 130 crores. On profitability, management expects to become free cash flow positive in the next 12 to 18 months. On back of this, brokerages have released their reports. Goldman Sachs have a buy rating with a target price of 1,100 rupees. Morgan Stanley has a buy target with a target price of 695 rupees. CLSA again has a target price of 650. JM Financial has upgraded its rating from sell to a buy with a target price of 600 rupees.
Okay, 4.5% higher on Paytm today. Surbhi, thank you so much for joining us with all those details. It's time to focus on Westlife Foodworld's strategy for 2027, which the management unveiled yesterday. Mangalam is here to get us all those highlights. Mangalam.
Well, for Westlife, remember, this is the company that operates the McDonald's franchisee in the south and the west of India. They come out with their strategy periodically, and this time it's come up for the next 5 years, which is 2027, and the vision looks rather big because they're looking at 4,000 to 4,500 crores in terms of revenues by 2027, and for perspective, FY22 sales were just around 1,500 odd crores. Importantly, they believe that this will also be with more margins, 18 to 20% EBITDA margin versus FY22, which was at around 11.8%. What will lead this? Premiumization, cost optimization, and high single-digit same-store sales growth. So those are a bunch of things that they'll be doing. Will they be growing their portfolio? Yes, at a much faster clip. In fact, they're targeting 580 to 630 stores as against just 337 now, which means that run rate for the next couple of years will also be over 45 to 50 stores per year as against 23, 24 stores that they've been adding per annum historically. And the long-term potential that they see is over 1,000 stores. So all of that means good business for these guys. Importantly, they're also looking at ancillary revenues. 100% of the revenues, 100% of the cafes they believe will have McCafes versus 81% now, and McCafe basically is margin accretive, revenue accretive as well, because it increases the occasions of consumption. Coffee is more of an on the go as against, burgers, which is a mealtime thing. So they believe that from 12%, the revenues from McCafe will increase to around 15 to 18 odd percent in terms of contribution. So all of this is something that the street likes. The stock holds up in the green.
Okay, so that is about Westlife Food. The stock is up around 1.5%. Now we get to Zydus Life. It has received a final US FDA nod for estradiol transdermal system. Ekta, explain this to us. And what does this mean for the company?
Well, this is actually important, because this is a drug which is actually used for menopause. And, it is basically a transdermal drug. So that means, like, think of a Band-Aid. You just put it onto your skin, and that's exactly how the body absorbs the drug. So this is a new form of drug delivery as well. It is a painless form of drug delivery as well. And this is definitely a type of drug delivery that requires much more in terms of scrutiny from the US drug regulator when they give drug approvals. For example, injectables, drugs used for eyes, as well as, transdermal drugs. So for Zydus to have received approval for this particular transdermal drug, while it might not be big in terms of market size, it is significant because it's a transdermal approval. Secondly, it is also from the Moriah facility. Remember that the Moriah facility had received a warning letter in 2019. It was re-inspected by the US FDA this year, received 4 observations, and is one of the few plants to in fact be cleared by the US drug regulator this year, despite having a warning letter. So getting the warning letter lifted from that particular plant. And that happened because they received an establishment inspection report with a voluntary action indicated status, giving the go-ahead to Zydus Life earlier in the month of November. So this is one of the approvals which have come through after that has taken place. And that gives you validation that yes, the Moriah plant is now out of the woods, and we could expect more complex drugs to get approved from that particular plant, such as this particular transdermal drug, which is for menopause. So important development for Zydus Life, not much in terms of a movement, but nonetheless. Let's take a short break. On the other side, we'll be talking to Mahesh Vyas, MD and CEO of the Center for Monitoring the Indian Economy, which is CMIE, and Theresa John, who is the Deputy Head Research and Economist of Nirmal Bang, for an outlook on CapEx. Stay tuned.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. We have been talking about markets, but let's put focus on the capex trends now and talk macros. According to a report by Nirmal Bang, private capex is now above pre-pandemic levels and is led by chemicals, renewable energy versus metals in FY22 and FY21. To discuss the trends going forward and the overall picture as well, we are joined by Mahesh Vyas, MD and CEO of Center for Monitoring the Indian Economy, and Teresa John, who's the Deputy Head Research and Economist of Nirmal Bang, who's the author of the report as well, joining us on the show to discuss more on the capex trends as well. Mr. Vyas, Teresa, thanks a lot for joining us and speaking with us on CNBC TV18. Ms. John, let me come to you first, because the report suggests that overall capex, which is up 2.9% on a YY basis, is still down 9.3% if we compare it to pre-pandemic levels. Can you give us a sense of where this decline is coming from and which are the growth drivers as far as capital expenditure is concerned?
Thank you. So what we see is that the overall capex is still around 10% below pre-pandemic levels, and the decline is mainly coming from the central government capex pipeline and the state government capex pipeline. Whereas if you look at the private sector capex, so for April to November 2023, when you compare it to April to November, in FY20. We are around about 52% above the pre-pandemic level, and on a year-on-year basis as well, we're up around 35%. So it's private sector capex which is kind of leading and now above pre-pandemic levels. And within private capex, the two sectors which are doing well, mainly it is chemicals, which is accounting for around 45% of the capex announcements, and second you have the renewable sector.
Okay. Mr. Vyas, I wanted your thoughts in this private capex data which Teresa is talking about, where she is saying that, yes, private capex has picked up, but the concentration of the capex is limited to only two sectors, which is basically chemicals as well as renewable energy, which have really been the toast of a lot of, maybe even the markets to a certain extent. So in your sense, is that your reading as well, that private capex, while it has picked up, is very concentrated and not broad-based?
Thank you. So what Ms. Teresa is saying is quite right. There is an increase in interest in the private sector and making investments, and the government has not been as active as the private sector has been. But, a small correction over here. This is not capex. This is capex intentions. So there's a difference. There's a very significant increase in private sector capex intentions. There is a concentration in chemicals and renewables. But what is important is that earlier these new investment proposals used to come largely from just one or two business houses. That has broadened now and has gone to many more states. So there is a broadening. There is a concentration in the private sector. Within the private sector, the investment is largely into renewables and chemicals. But mind you, that chemicals and renewables and energy at large are the ones that are really capital intensive. One cannot expect leather, for example, or garments to show large capex in terms of rupees value. So I agree that there is an increase in the intentions to invest by the private sector, and this should not be misunderstood as capex. Capex is still a far away.
Okay. So, Mr. Vyas, in your views, what are the key risks that we are seeing to the investment cycle? The intention, do you expect it to convert into execution as well, or there are some hurdles to that as well?
So, we are surprised by the slow rate of implementation of projects in 22-23, because 2021, 22 as well, to some extent, was impacted by the pandemic, the lockdown, and therefore there was a huge backlog of investment projects that were expected to be completed in 22-23. So when the year began, we expected 10 trillion rupees worth of projects to get completed, when the highest number in the past was around 6.5 trillion or so. But half the year is over, and we have still just seen about 2.5 trillion rupees worth of investments getting completed. So there is still significant sluggishness in the completion of projects, and therefore the real capex cycle has still not started.
Okay. All right. So that's quite significant, and that's, intention of capex in the private space. But Teresa, your data indicates that the central government capex pipeline is even lagging pre-pandemic levels. For example, April to November FY23 data indicates that capex announcements are down by 76% year-on-year and 71% below pre-pandemic levels. These are just announcements. What is the kind of data that is indicating complete execution from the central government side when it comes to capex? And where would it probably be concentrated on as compared to pre-pandemic levels? This is execution that I'm talking about, completed capex.
So actually, pre-pandemic, because the private sector was hardly doing or even announcing any capex at that point in time, the central government was actually taking the lead. So you had a strong pipeline before the pandemic, and I think some of that they were able to push through, when there was no private capex happening, during the pandemic. So that's why you saw, during the pandemic, we had a lot of projects by NHAI being implemented, where there was any other when other sectors were largely not active at all. In terms of capex announcements, while NHAI and the renewable energy sector again was the leading sector during FY21 and FY22, now we've seen a shift back to railways. So that was the case before the pandemic as well. So railways accounted for over 40% of projects in the pre-pandemic period, and now we are back to that level of around 37% accounting for by railways in the period April to November FY23 in terms of the capex announcements. That said, as you pointed out, the quantum of projects announcements has significantly dwindled when you compare it to the pre-pandemic period. So the concern is going forward, if the private sector does not actually implement some of these announcements, the government also does not have a pipeline in place, to go ahead and take the baton from the private sector like they have done in the past.
Okay. Teresa and Mr. Vyas, just hold on. We'll have to get into a quick commercial break. When we come back, we'll continue this discussion on the other side. Stay tuned.
Well, we are still in discussion with Mr. Vyas of CMIE as well as Teresa John, the economist at Nirmal Bang Securities, about the current capex cycle. Mr. Vyas, Teresa was apprising us about the details with regards to the central government capex pipeline, and that is still lagging pre-pandemic levels. But where exactly does it stand according to you? And do you think that the state governments could probably be lagging behind even more? And what can we expect probably in the second half?
Yes, you're right. The state governments are lagging behind on capex spending. So we see this in the financial statements of state governments and central government. So the central government spending on capex has been pretty aggressive this year in the first half, but the state governments are lagging behind. What we have seen from past data is that the state governments usually catch up in the second half of the year. So maybe there will be some turnaround as the year goes ahead in terms of government spending on capex. So far, it's been half and half. Both state and central governments have equal contribution to capex, and the central government is doing well and not the state government.
Okay. Teresa, you have spoken about how chemical sector is contributing to what the growth that we are seeing in the private segment. What were the sectors that contributed earlier and are seeing a decline right now? And within chemicals as well, there are so many segments, right? So where is the most amount of money intended to go for now?
Yeah, so compared to say FY21 and 22, we had two sectors that were leading then. One was metals, because metal prices had started going up, during the pandemic, and that led to a lot of capex announcements in that sector. And then we had the electronic sector, which is mainly led by the PLI scheme. But most of that capex announcements seem to be complete because they have to complete the projects in order to get the PLI incentives. And we have actually seen a pickup in electronics exports, on a year-on-year basis with that capex actually coming on stream. So from electronics and metals, now we've seen a shift to chemicals, and chemicals is, as we spoke earlier, it's accounting for around 45% of the capex announcements. Within the chemical sector, the top sector is obviously green hydrogen and green ammonia. Again, this is a few large projects in these sectors, and then you have a alumina project by Adani, which is accounting for another 10%. So these green hydrogen, green ammonia projects plus the Adani alumina projects accounts around 75% of the capex announcements in the chemical sector. And then we have a large number of projects coming in for ethanol refineries because of a government incentive. In terms of value, they may not be very large, but the number of projects are quite large.
Vyas, unemployment as per the CMI has risen to a 3-month high. What is it indicating? Do you think that it could rise beyond this 8% that you've released in terms of data?
Well, I don't think it will rise much beyond 8%. What we have seen in the recent past is that the unemployment rate kind of hovers between 6.5% and 8.5% max. So at 8%, we are at the upper end of that range. But the unemployment rate is unlikely to deteriorate any further because in the last couple of months, we are seeing the labor markets being giving us a little more positive news. Most importantly, there's an increase in the labor force participation rate, which I think is a more important indicator. So, no, I don't expect a major deterioration. In fact, the rate at which the deterioration was happening earlier has kind of stopped.
Oh.
So we have possibly hit a bottom, and we should be seeing things improving from here.
That is good news to hear. And on that positive note, Mr. Vyas Teresa, thank you so much for joining us and speaking with us, telling us all about the capex trends in India Inc. and the governments as well. Time for a break now. Prakash Gaba will join in with some... Welcome back. Still tuned into Halftime Report on CNBC-TV18. Markets are at the day's low, barring mid-cap index. All the other indices in the red today. So it's a good time to get a check on the F&O action as well. Manglam is joining us to get us up to speed. Manglam?
Well, it's an important mark what we're watching out for the Nifty right now. It's the 18,650 mark because we were hoping for some sort of support coming between 18,650 to 18,700, and that is a zone where we have consolidated over the last half an hour or 1 hour or so. So were the markets to bounce back, this would perhaps be the level to keep an eye out on. And why do I say that? Well, because yesterday we did see a fair amount of writing at the 18,700 put for a 50 rupee premium. We also saw some writing at the 18,800 put for almost a 100 rupee premium. But now as we speak, we aren't seeing much unwinding in the 18,700 put despite the premium jumping from 50 odd rupees to 100 odd rupees. And the 18,700 call, however, is seeing a fair amount of writing for the premium of 100 rupees. So what's happened is that while the support has remained between 18,650 to 18,700, we have to see whether resistance has come lower from 18,850 to around 18,800 thereabouts, because that's where we're seeing a lot of action in the 18,700 call. So if you just take a look at the 18,700 call and the 18,700 put, we will see that a premium of close to around 200 rupees is what the street is playing for the next cycle of expiry, which is December 8th. From 18,600, 200 points on either side, which is 18,400 to 18,800 is the broader range. But from where we are right now, it's an important support zone to watch out for the Nifty itself. And this ties into the fact that the mid-cap index is outperforming. It's actually at the high point of trade. And that usually happens when the street believes that maybe the downside on the Nifty is limited. So we have been around that 18,650 mark for the last 15-20 minutes. Let's see whether we support from here or not.
Okay, all right, Manglam. Thanks very much for that. So 18,652 is currently where the Nifty is at. Prakash Gaba joins in to tell us what he's strategizing at the end of this week. Prakash, hi, welcome to the show. Well, it's definitely been a week where the mid-caps have outperformed, and, Manglam alluded to that as well. Overall, what would you probably pick from the broader market space?
Well, good afternoon to you. Looks like the market is correcting here. It's correction. I wouldn't call it a correction. I would say it's resting here, a pause, a breather after a big run. Basically, the trend is still intact as long as we have a level of around 18,600 that holds. In fact, 18,500, very, very strong support zone. So I think it should hold. And Bank Nifty front, perhaps 42,800, 900, strong support zone. If the market has to bounce, the place is right. Only thing is, even if it doesn't fall, it's good as long as we are looking at next week. Stocks that I like is Tata Steel. I think it's showing some momentum. I like the stock. It's trading at 1111 to 112 zones in between that. Very good chance it can climb to 114 to 115 in the days to come. And stop below 110.50 or 110 should be fine on Tata Steel. So Tata Steel looks like a good buy. Second stock that I like, I think, is Apollo Hospital. Given a beautiful momentum. Looks like the way it's trading after a good 3 days of consolidation is good, trading at 4860. The next technical target that I'm looking at is around 5,000 rupees. May take its own sweet time, but 5,000 looks like it's on the card, a matter of time. Stop below 4,800 on Apollo Hospital should be fine.
Okay, all right, Prakash, thank you for joining us. So those are some technical picks coming in from Prakash Gaba. For now, slip into a short break. On the other side, we'll discuss some stocks which are in news today, reacting to news updates and a lot more. Stay tuned. For the mid caps, in fact, this index has outperformed this week as well. So that one is up 200 points as we speak. And a lot of these names which are contributing to the gains that we are seeing on the mid cap index as well. BHEL, that should come up for you on the screen. It's up 6.5%, slightly off the highs, but still has seen good gains. This week itself, the stock is up 10%. So continuing that momentum. M&M Financial is the other one. So that one is up around 3.5%. We also have L&T Financial Holdings. So some of these financial names which are in focus today. And the other one that I'm watching out for is Manappuram Finance. That stock too higher by 2.5%. So that's all about the broader markets. These stocks have done well this week as well. But let's talk about the Nifty pack now. We have Divi's Labs, which is in focus. It is on the back of a Morgan Stanley note. Ekta, what does the note say?
Well, yes, Divi's Labs is in focus on account of Morgan Stanley, in fact, writing on it. And they have, in fact, initiated coverage on Divi's Labs with a underweight rating. So they have a target price of a little over 3,000 odd rupees. According to them, it is a strong business, but is in a lean phase. Strong shareholder returns have taken place over several years, but it now appears to be going through a lean growth phase. They expect relatively slow EPS growth phase versus what we have seen historically for this, and that can possibly drive underperformance going forward for Divi's Labs. In fact, the valuations appear rich. They trade at around 38 times FY23 estimated EPS according to Morgan Stanley, and over 34 times on an FY24 estimated EPS. Now, however, important points to note on the positive side: cash-rich balance sheet, around 3,340 crores of cash on books. And separately, the company has a capital-efficient business with around 24 to 25% return on equity.
Okay, so the stock lower by 1.5%. Thank you, Ekta, for getting us all those details. So that's stock from the Nifty pack in focus. But let's go back to the broader markets. MOIL, it is surging in trade today. The company's production and sales have jumped in November. Nigel is joining us with all those details. Nigel?
Well, that's right. A pleasant update coming in from MOIL for the month of November. They say that their sales and production numbers both have looked rather good. Now, on the production front, they said that they have produced close to 1.2 lakh tons, which is a growth of close to around 60% if you compare it with October 2022. So that's a sharp growth in terms of production. But sales are more important, right? So on that front as well, they say that they've recorded close to around 82% growth during the period over the previous month. So good update is what they've given for the month of November. That's not all. The management commentary is positive because they believe that they're expecting a much better performance for the remainder of this year. So good on them. Explains why the stock is up close to 4.5 to 5%.
Okay, all right, Nigel, thanks very much for that. So buzzing in the broader markets, PB Fintech sees a 5% block of shares largely sold by SoftBank. Vivek is here with the details.
Well, that's right. So today morning, in the block deal window, you saw a large trade. Over 5% of equity exchanged hands as far as PB Fintech, that's Policy Bazaar, is concerned. This particular block deal happened at, above the floor price, that the term sheet indicated. As per our sources, we understand that SoftBank, that held over 10% of equity in the company, has exited the entire chunk of 5.1%. So they continue to own over 5% stake in the company. Now, remember, there's a 60-day lock-up period for a further sale of shares as far as SoftBank is concerned. So for another 60 days, SoftBank can't sell as far as PB Fintech is concerned. Now, looking at PB Fintech, the anchor lock-in ended on November 11, 2022. And after that, this is the second large fund that sold. Tiger Global also paid a significant stake that it held in the company. This particular block deal happened on November 11th as well as November 14th. So the supply of shares from, the pre-IPO anchor investors continues as far as these names are concerned.
Okay, Vivek, thank you so much. The stock is in focus, up 2%. But, the other big issue for PB Fintech has been IRDAI's efforts to get Bima Sugam going. We recently had the IRDAI chairman calling it a potential UPI moment. Here is some more opinion from the insurance industry on what Bima Sugam could mean for the industry. Let's listen into Nilesh Sathe, who's the former IRDAI member, Shelja Lal, who's partner head of insurance practice at Shardul Amarchand Mangaldas and Company, and Neeraj Shah, who's the CFO of HDFC Life, and listen into what they had to say on this.
it may be disruptive, but then you are giving more choices to the customers. It is always better to give more choice to the customers. Now, those who want to buy a product online, maybe at a slightly lesser cost, they have got one more option which is available. As it is, all insurance companies have got online platforms where the price is slightly less. But here, if it is going to be substantially less, then there is a demand from aggregators as well as brokers that you allow us also to give some concession in premium when we sell the product, which is at present not allowed. They have represented to the IRDA. Let us see what is the outcome of it, but it's a welcome move.
It's not going to kind of completely disrupt the market because, for example, again, Policy Bazaar, they've kind of moved from web aggregation to insurance broking, right? So they'll be, online broking platform now. So, and all insurance brokers, insurance companies and insurance brokers do have online platforms where they sell insurance online. Post-COVID, that's where most of the insurance, is sold. Not most, but a lot of the insurance is sold.
We are very excited about this development. I think it is more power to the consumer, and it allows the manufacturers to get more access directly to customers, in addition to the distribution channels through which we come in touch with customers. So I think it's a great initiative in terms of bringing all the segments of onboarding, servicing, and claim settlement for customers in the manner of their choosing.
Okay, well, we need to take a short break with the news that the mid-cap index is managing to hold its head above the water. A lot of stocks buzzing around. Sadbhav Engineering, for example, is up 13-odd%. BHEL is also up around over 6-odd%. Fiat from the tire space has been buzzing around all week, and that stock gaining 6-odd% as well. Time for a break now. On the other side. Welcome back. Well, stable for the markets as compared to the last time we spoke about it. So we have the Nifty, which is down around 151 odd points. Sensex, which is down around 541 odd points. On a week-to-date basis, it's just a marginal movement for the Nifty and the Sensex as compared to what we've seen, at least for the mid-caps, which have outperformed on a week-to-date basis. We do have a lot of cues which are lined up for the next week, so do watch out for that. The Reserve Bank of India policy, as well as the US jobs report that the street will be reacting to on Monday. But nonetheless, we do have Manisha who's joining in now to give us a roundup of what's taking place in the entire commodity market. Manisha, over to you.
Ekta, thank you so much for that. And I have a guest as well. Sanjay Gupta is MD and CEO NCML, and he joins us on the show. And he'll talk about the agriculture markets, where we have seen the Rabi numbers especially coming on the stronger side. But apart from that as well, a lot is being done on warehouse receipt side. We have seen, or there is an expectation that the AUMs under warehouse receipts also are expected to gain up. Sanjay, hi, welcome to the show. I want to start with the kind of numbers that we're looking at. Rabi crop to begin with, 7% higher as compared to previous year. The surprise clearly comes in case of pulses. But what is your overall reading on the numbers right now?
See, Manisha, thank you very much for having me here. It's a pleasure. See, as you rightly said, the production estimates have come up very higher, but we are seeing a situation of a kind of a stalemate in the market. The arrivals are much lower compared to what they were last year at the same time. So I believe this is because the prices are yet to settle in. The farmers have a high expectation of the prices, and the market somehow, as of now, the prices prevailing are lower. So we are seeing very less arrival compared to the last year, but hopefully the situation will improve going forward in the next month or so, when the prices will stabilize and realization will set in that the prices are going to be in this tone this year.
Oh, well, absolutely. When you look at the last 3 or 4 years, Sanjay, it was COVID years, and before that as well, markets were looking at slightly weakening in the global markets as well. We were looking at a slowdown in any case. How has that worked or not worked when you look at the post-harvest market here in India?
See, last year, as I said, most of the commodities, including this year, we have seen a bull run. Right. The prices were at all-time high in most of the commodities. But as of now, with the arrival of fresh crop, the prices have come off a little. So as I said, that the issue is that the farmers are looking at the peaks they have seen in the previous season, and they are expecting same prices to prevail. But as of now, from the buying side, from the consumer side, we are seeing a resistance to buy at those levels, especially the people who do stocking. The end consumers anyway are buying whatever is a requirement, but the stocking and the other people who do take positions in the commodity market, we are seeing a reluctance on their part to take positions on this prices because they probably expect a slowdown in their demand or they expect the prices to cool down. So as I said earlier, there is some sort of a stalemate in the market. And as of now, the trade is much lesser. We are seeing arrivals in warehouses is much lesser compared to the last year because the overall arrivals are less. And whatever arrival is there, from the stocking point of view, people are not taking positions as of now.
Oh, clearly. The higher prices have clearly made farmers want to hold on to their crop for a longer time. But the kind of measures that we've seen in the last year or so from the government side also, not too many traders, stockists for that matter, are very comfortable holding long positions in warehouses too. Do you see that having impacted the markets as well? And the other thing really is about the overall futures derivative market with so many commodities suspended, the hedging mechanism as well not available.
True, you are right. One of the key reasons is that on the commodity exchanges, a very large number of economically significant crops are under a sort of ban. Hopefully, December is the time when maybe there will be a change going forward. But as of now, there is a ban, and we have seen this reflect in the revenue turnover of the exchanges also. So just now recently, the government has lifted stock limits on some of the commodities. And hopefully going forward in the month of December, when the one-year ban period gets completed, this ban will be lifted too. So then we will see a lot of vibrancy to come in the market. As of now, there is a dull period. Arrivals are less. Hedging mechanisms are not available for the players. So that is why there is a fear on both sides. The customers think if they sell it now, maybe they will see higher prices now. On the other side, the buyers are hoping if buyers are fearing that if they buy now, maybe the prices will come off in the future. So that's the situation. As I said, maybe it will take some more time for the arrival pressure to build in, the demand also to stabilize, stockists also coming in before this prices settle, and then the marketplace will enter in a big way. Plus, if this NCDX ban or the commodity exchange ban is also removed, then this will also enable this traders and stockists to take a better position in the market.
Absolutely. More hopeful times coming ahead. Well, that's about the overall market, Sanjay. But a final question on NCML itself. What is the kind of market share that you're holding? What are the tie-ups? You've recently done one with Food Corporation of India as well. So what are the plans going forward till the time Rabi crops come into the market?
See, Manisha, you know that we are working with FCI for the storage of their wheat. And there is a small pilot on storage of rice also in 2 locations in Bihar. As of now, predominantly it's wheat. So we are building silos for them with a 30-year concession agreement and the stocks will be maintained by us, obviously, but the procurement and other things will happen by FCI. These are 10 locations in India as of now. 7 are under various stages of construction. 2 have been completed and handed over to FCI. 3 we are hopeful of completing and handing over to them before the end of this year or say this month itself. And 3 more, the work is going on, and another period of 15 months. We will be having 10 silo locations working in India. So we'll have 2 in Punjab, 2 in Haryana, 3 in UP, and 2 in Bihar. So this will be the total split up, and the total holding capacity of this will be 5 lakh tons, wheat and rice. And the total capex required for this implementation of this is about 900 crore rupees. So we have invested a very large part of it already. Some remaining part investment need to be done, but by the end of fiscal 24, we will have all these 10 silos up and running.
Okay, Mr. Gupta, thank you so much for joining us. And Manisha, thank you for taking us through what's happening in the world of agri-commodities. That's all about commodities, but we'll wrap on this edition of Halftime Report. And as we do that, we leave you with some global and Indian market opinion coming in from Jahangir Aziz of JP Morgan. Listen to his outlook on Fed rate hikes and inflation. And with that, it's a wrap.
Our concern is that maybe inflation is so entrenched and the labor market does not break soon enough so that that additional disinflation that is required to take it down to, comfort levels of 2-3%, that doesn't happen, and the Fed is forced to start rehiking aggressively in the second half of the year, and we have about a 25% odd probability to that scenario. So yeah, I mean there is a scenario out there where things work out this way, but not that the terminal rate keeps on going. The terminal rate is taken to 5.25. You go for a pause, and then you're forced to rehike. Rupee is clearly benefiting from the fact that dollar is weakened, and the dollar has weakened over the last 2-3 weeks, largely because of the shift in market sentiment towards how much rate hikes will be there. As I said, we'll have to wait and see where the terminal rate goes. and where, you know, what happens to European growth in the fourth quarter and the first quarter. Right now, all the fears that we have about European growth going down and going into a massive recession, the recession fear is still there, but it's much shallower. And I think it is these two things that is weakening the dollar and strengthening the euro at this point in time. Rupee's problem has, you know, very little to do with the dollar. Rupee's problem has to do with the fact that India is running a very large current account deficit, is running a very large fiscal deficit. It has inflation still around 6-7%, and it is providing almost no compensation for that macro risk. So I know that you keep talking about, you know, how the FIs haven't moved in either in the equity or in the bond space, but there's a reason why the FIs haven't moved in. There is a massive macro risk on India, and there is very little compensation either in the high equity valuation or in the high bond valuation or on the high FX valuation.